Good morning, everybody. Welcome to the Mortgage Coach Friday Mastermind. Every Friday, 9 o'clock Pacific, we're here to bring you wisdom, leadership, and hopefully today we'll get a little confidence and hope. It's been a pretty rough ride in the mortgage space as it pertains to interest rates. And we are right into starting the spring home buying season. So I think it's never been more important that we get an update from the man, the myth, Dan Rawitch, the chief economist for Mortgage Coach. What's up, Dan?
Hey, Dave, how are you? Thanks for having me.
It's good to have you. Todd Bookspan and I will be co-hosting, co-facilitating this. What's up, Mr. Win by Noon?
You know, not much. I think you nailed it, right? The number one challenge is that loan officers are fearful about interest rates, right? Everyone's clients are fearful. It makes loan officers fearful. And the bottom line is Dan always gave me the confidence, still gives me the confidence since I'm part of his program, which I'm sure we'll be chatting about as we go. But ultimately, in the end, it's all about understanding what's going on so that you can explain it to your clients. Because when you actually have the knowledge, then you're empowered. And when you're empowered, you have confidence, and confidence is what you need in this market, regardless of where rates are going. So I'm super excited. As always, got my pen and paper ready to take notes.
You flatter me.
So I interviewed Keith Collins yesterday for about 25 minutes, just put that into the YouTube channel. And it was how Keith is handling today's objections. And some of the objections that are coming in today is, should I buy now? Should I buy 20% over list price? Because that's what it takes in some markets to win a deal. It does, 5%, 10%. Should I do that? Realtors need to sell homes. They need to talk about, should I list my home? Mortgage professionals, you can help with that because you can do a move up analysis or a move down analysis. There's a lot of folks that, hey, should we move down now? So people are asking, should I list my home, move up, move down? Is now the time to buy? Should I pay more? Are interest rates going up or down? Guys, these are objections. These are issues. Dan, hopefully you can answer all of those today. And we will pop in and out, ask you questions. If you're watching this live, put your questions in chat. Whether you're in Facebook or you're in Zoom, put your questions in chat. And if you're watching this on our YouTube channel, we'll get all your questions answered. Put them down below. Mr. Rawitch, take the stage and answer all our questions.
All right. It's a big task here. Let me share my screen real quick. As always, I probably have a few more slides than anybody wants to look at. But primarily, guys,
real quick,
these slides.
Are you gonna share these slides with us? Are we going to get these?
You're not seeing them? Oh, yeah.
No, are you going to share the actual slides so we can put them in the
Absolutely.
The file
in fact, I sent you a link to them, Dave, just before the call.
Okay,
so
guys,
you've got them already.
I will get those in there within the hour. And I do want to, when you watch that Keith Collins interview, you notice that Keith has kind of his own running deck. He's got Mortgage Coach TCAs, and then he's got slides, some from Dan, some from Keeping Current Matters, some from different, just different sources. But he's got these slides that help him answer questions when he has them. So stay tuned for these guys.
Yeah. And again, these slides are for you. I probably have more slides than I need to be talking about today, but I really think some of these will help you with your clients. And so I may not spend a lot of time talking about them, but you may find use in them. But I will touch on each one of them. And then just to frame this, that I love to give you good news, and I love to, I don't love to be a contrarian, to tell you the truth. It can be very lonely. I wasn't born a contrarian. And I've shared this a lot of times, but my very first business class in college, like literally Business 101, the instructor wrote in huge letters on the blackboard before he even said his name or anything. He walked in, turned his back on the class and wrote, "The mass is always wrong." And he put exclamation marks, all across the board. And he turned around, he said, "If you learn nothing else from me this semester, never forget this. Because if you want to be average your whole life, just follow everybody else and you'll be just as average as you want." And that stuck. It really stuck. And he, even I remember when I bought my first home, everybody was talking about interest rates going up and it being not a good time to buy. And I just said, well, that's what the mass is doing. So I think I'm going to buy. But there's times, unfortunately, where the mass is not wrong, and you can't go against them just because it's cool to say you're contrarian. And so you are hearing a lot of things about interest rates perhaps getting worse. I am in that camp. The last call I did, I think it was just a month or two ago, I did caution that I thought things would get a lot worse before they got better. So I'm going to talk about that, but I'm also going to talk about, more importantly, what does it mean to the housing market and buyers? But the slides are yours. And a couple of people have said, man, how do you spend so much time putting all these slides together? So I want to be real clear. I jack all my slides from various sources. That's what I do. But like I'll go to the Federal Reserve site, and a lot of those slides I created myself, but there are some keeping current matter slides because there's some really valuable data. But so I just want to be clear on that. My time is spent, hours gathering meaningful slides, not necessarily creating them. Okay. I just don't want to take credit that I don't deserve. So this is the story, man. Food prices are going crazy, as you know. We do have some concerns about food shortages. I wouldn't ignore those concerns. I don't want to like create this mass fear or anything. We're all going to be just fine. But the situation with the war, it's causing fertilizer will be almost non-existent. Grain will be extremely difficult to get your hands on, and oil could get well above $150 a barrel. So this inflation thing is going to, I think, get a little worse before it gets better. My wife was she was on Amazon last night, and she was ordering things that have a long shelf life that we like during the pandemic. We literally went to one of those emergency sites, where like survival sites, and we stocked up on stuff that, frankly, I hope I never have to eat. But that's how worried I was during the pandemic of just everything running out. I'm talking about in the very beginning. So hopefully I'm wrong again. But so I said this time, buy stuff we like. Like let's not just buy that, yucky stuff. But what happened during her placing her order on Amazon, she was getting pop-up messages of some sort. I wasn't watching it, but she's like, oh my God, those noodles you like, which are like, I don't know, yakisoba noodles or whatever. They were $19 for a cart for, a little mini case of them. I just got a pop-up message saying that they're now $26 while she was in the process of ordering these things. So just keep an eye on that. And when you see these kinds of things start falling into place, then you'll know that inflation is nearing an end. So, unless you are Rumpelstiltskin and you took a big nap, you know that the yield curve did invert. It didn't stay inverted very long, which is actually a very good thing. But as you know, historically, an inverted yield curve has predicted, I think, 9 out of the last 10 recessions. And this is what it looks like. So when we talk about the yield curve, mostly I talk about what's called the TED spread, which is the spread between the 2-year and 10-year. And that is historically, 1.5% to 2%. This line is the spread between the two, meaning so the 2-year bonds might be 0.5% and the 10-year should be 2.5%. That's a normal healthy yield curve. It's actually what you want. And then you can see each time it inverted, these grayer lines are recession. So there is a lag time each time, but it pretty much always does come. And it doesn't have to stay inverted long. It just seems to trigger problems. This is taking the average time that it happened over the years. The average months till recession are 12. And as crazy as this sounds, I'm just going to say the sooner the better, because we're going to need the Fed to have some pressure, inner conflict about how fast he raises rates. We want him to not get too crazy so that We want him to raise him enough so that he can slow inflation down, but not so much that, we can't sell mortgages anymore. And I don't think that's going to happen. This is Nordia, who is a pretty good prognosticator. And this is more stock market driven. And I think these two are going to correlate very closely in the near future. But they said this is not about the 2s and 10s, meaning the spread. There's far, far more going on. They see a 20-30% downside in the stock market. I fully concur. With our options trading program and stock trading program, we try not to have a bias. I try to keep these things more in the back of my mind. But because when the market is moving up, we don't fight it. But you've heard that saying, I'm sure, over the years, don't fight the Fed. And so even after the pandemic, it seemed so weird that the stock market would go up. And I just didn't believe that it could. And yet I was, in my mind anyway, I was fighting the Fed, because when the Fed was just pumping money into the system, there's no way the stock market's not going to go up, no matter what's happening in the underlying economy, to a certain extent. And so right now, I think that anybody that's really forcing a bunch of long positions in the stock market, they're fighting the Fed. Because what does the Fed want? The Fed wants to drain money out of the system. The Fed wants to see rates go up. The Fed wants a less accommodative stance. And so all that, it's never equaled a good stock market. So if you're in the market, just be real careful. Keep your finger on the trigger. So this is stunning. This is the Consumer Confidence Board sentiment spread. And, rather than spend tons of time explaining what the spread really means, I just want to point you to what happens when it goes below the line. This was the crash of 2002. This was the late 70s crash. This was the pandemic crash. And we are below any of those things. So there's got a tough ride coming in the stock market. I don't want to use the word excited about it because, it sounds mean, because people will get hurt by it. But this will be a trader's market. This will kind of thrive on this stuff. And you can too. You don't have to know that much to benefit from this. And if anybody wants help, send me an email. I'll help you. Now, this is where you kind of take this data and you have to synthesize it. This is a cycle indicator.
Wait a minute.
It's pretty good. I have followed this for
I want to jump in. So Dan just said, hey, and if you want some help, I'll help you. Just email me. Guys, get involved in Dan's mentorship program. That is why Dan originally started that program. He said, hey, Dave, I get a lot of people calling me up looking for free advice. Go to marketmentorship.com and Dan, you do so much for this community. I personally think you should just hey, answer questions like that for the people in your mentorship program, or guys Dan on Facebook. If you have a question on that, put it on Facebook. But,
well, let me throw something in there, because I'm a member of it, right? Like, I know we all love it anytime that Dan comes on here and does this, but I get a deck of slides like this from Dan every Sunday night. With a video. It's anywhere from 18 to 25 minutes. I don't think I've ever told Dan this, but I actually download it and then I put it into QuickTime and I watch it on double speed. So I watch it half the time. Dan's really talking fast, going through these graphs. But it really gives me knowledge and excitement about it. And then of course his trades, which transparently I don't do because I don't have time to be trading, which maybe there's probably some way if I pay better attention to Dan, I can do it with not being glued to my screen. But I mean, they're crushing it. They're up like 160 to 70% this year. So they're really doing great.
Yeah. Thank you, Todd. Thank you, Dave. I really appreciate it. Yeah, Dave is he's like a good agent for me, because I do give stuff away, and sometimes it's even the option trading business. I remember when I'd first left my corporate job, I just mentioned on my podcast that I was back to trading options and how excited I was. And oh my gosh, I got, I don't know, a couple hundred people say, hey, can you teach me how to trade options? And I didn't even think about making a business. I said to Sophia, how can I help that many people at the same time? Should I just do classes? She says, yes, and you should charge for them. And I'm like, I could never do that. Anyway, I learned how to charge, but I'm still a little awkward about it. Okay, so back to this expansion.
Gold, pure value, and guys, there's a link down below to get mentored by Dan. We highly recommend it. Keep it going, bro.
Thanks, guys. So although we do see a downturn coming, this is kind of telling you we still are in an expansion phase. But if you trust the chart, we're probably nearing the end of it. And that'll put you in kind of this red zone, and this red zone sort of always equaled a recession. So I still see that that's coming. And by the way, again, when you hear recession, you should think reduction in rates, because there's really no way around it. The wild card was, again, back in '80 when we had a pretty deep recession and double-digit inflation. My hope is that we don't see that kind of inflation at this point. And I think if the Russia-Ukraine thing gets solved fast enough, inflation could moderate, much more quickly. The oil thing is a concern, and again, that's like, I don't think, who knows, but I don't think we'll ever buy oil from Russia again. And depending on who's in office, I don't know when we'll start doing shale drilling and stuff again. But we do need to be energy independent in my personal opinion, because things like this are not acceptable for a country of our size. This is OPEC giving us the finger, frankly. This is OPEC members are keeping their production below their quotas. How dare them? I mean, come on, like, why? So I just think they want to keep pressure on our oil prices, which is just wrong. And it wasn't happening when we were able to produce enough of our own energy. And again, regardless of your political position, I would say try to put that aside. It's hard for me sometimes, guys, but sometimes just stuff that in the back of your mind. Forget about CNN, forget about Fox, and think about what's just logical. And energy independency is logical, and we would not have oil at this price right now. So this is about companies recasting their earnings and giving guidance in this last earnings cycle. And you can see the earnings sentiment is dropping pretty fast, and stocks do trade on a multiple of earnings. This is an interesting slide because 1994, Todd, were you in the business in 94?
I wasn't, but I keep hearing, maybe it's from you, but I keep hearing that we're getting a similar market to 94.
Yeah. Yeah. So 94, the Fed raised rates, as I recall, 9 times in 1 year. And it was particularly painful because there was a refinance craze that was just unbelievable in like 92 and 93. And we were all just cleaning up. I had started RPM Mortgage in 89, and it was just, you couldn't get more lucky, than starting it, having the foundation built, and then having rates do that. And just when we were just like fat and happy and driving the fancy cars and all the things that we do as young loan officers, we got smacked down. So the 94 line is the blue, and this is every single Fed increase that happened. And this is where we are currently on the forward curve. And so it's beginning to look a lot like 94. But here's the good news. It did stop, it did moderate, and it did start stepping down almost as fast as it started going up. So you're already weathering more of the storm than you realize, but you still have to keep the windows, battened down. And I call it duck or bleed. And that doesn't mean you don't work your butt off. That just means you control your expenses and make sure you're spending money on things that you should. But know this, a lot of your competitors they're under their desk crying. And there's a tremendous opportunity. We ended up doing extremely well. We had a really rough first 6 months during the rate cycle increase. And then, we just said, let's be positive. Let's go out there and be a beacon of light for the real estate agents. Let's help them. Let's train them. Let's give them tools. And our market share grew more in 94 and 95 than it did at any point in the history of the company. I can't say if that's true anymore. I haven't owned the company in a long time. Rob Hurt does now. But my point being, market share has grown in these markets. Market share is not grown in rapidly expanding markets. A rising tide lifts all boats, and it's very difficult to grow market share. It's easy to grow volume, but not market share. Big difference. Market share doesn't go away. MBS. I think most of you are aware of this, but if let's say that rates are 5% and you had a 5% pool of mortgages, And so the market's at 5%. That pool will sell for 100 cents on the dollar. That's the fair market price for the right rate. And then if you're selling 5% bonds in a 4% market, well, they're worth more. They might sell for $1.20 on the dollar. So one's called a premium, one's called a discount. It's the same thing when you're pricing your loans. You know, a lender incentive is just because you're selling a higher rate and the lender's able to sell that loan for more. MBS agency loans have been trading below 98. That's not very good. So there's been a little bit of a lack of demand in bonds. But that actually last weekend I shared that actually is getting better. We're starting to see a little tiny bit of buying come back into bonds. Okay, here's your housing pitch. I got these slides off. If you go to the St. Louis Fed, you will be amazed at the type of data that you can. You know what? That's not true. I really need to show you guys. These came from your best friend Zillow, and I'm just going to take 1 second, maybe 1 minute, and show you how we get these slides, because this is a tool that you definitely want to keep in your toolbox. Oh, where are you guys? Let's just start from the very beginning. If you just type in Zillow data, that's it. And then let's just scroll down a little bit, and here is home data, Zillow research. Look, might as well use their research because they spent a whole bunch of money on this stuff. So if you wanted to know, let's just say inventory for your market. How about new listings? I like all homes smoothed out monthly. Geography, it only lets it, you have to pull down the whole thing. Hit download and watch this. This is how this slide was created. Let's just say New York's on top, so I'm just gonna use that one. So I'll just highlight this. If you're in a city that's down below, just copy it and insert that cell, and then scroll here, and then just go to your insert chart. Boom. There you go. This is New York's, whatever I said it was, new listings. And you can do this for every major metropolitan market in the nation. So it looks like I grabbed New York, and I grabbed Los Angeles, and then the big one is United States. Like, I shouldn't have put United States in there because it dwarfs the other numbers so much that they almost don't make sense. But I could have just put New York down there, and I could have put New York and the US, but this is great data, guys. So that's where these next slides came from. I did create them, but they're very easy to do. I think I love that. United States rental prices. If anybody says, should I buy a home? Your question should be, I don't know. What do you think about this? What do you think about all the people that bought a home in 2012 and had a $2,000 house payment? What do you think their house payment is today? Oh yeah, it's $2,000, and their principal is down how much versus these poor SOBs that had rent of $1,400, now paying $1,900. This is real. I don't see this stopping, frankly. So I personally don't care if housing prices drop or not. I don't care once I have my mortgage if rates go up. In fact, if rates go up, I'm even that much happier because I've locked my house payment in forever, and these guys have not. So to me, that is the number one message when people say, should I buy a home? This is the rents just after the pandemic. So starting in 2 of 20. Wow. That's just, to me, that's stunning. I'm used to seeing this because, I studied these structures my entire life. This is more normal, like almost nothing happening, maybe tiny little, 1 or 2% CPI increases. These are home prices. And so, yeah, home prices have gotten pretty tough, but so have rents. So I do think this is going to normalize. It has to normalize because this is starting to look bubblicious. We really don't want to see this go up at these double-digit rates. It's not healthy. I'd love to see home prices calm down to about a 2 to 3% appreciation. And as I told you guys last time, if I had 100, I'm just using this number for simple math. If I had $100,000 home and I put, let's say 5% down, That's 5,000 of my cash. If that home appreciates 3% a year, 3% of 100,000 is 3,000. I'm making $3,000 a year on my $5,000 investment. That's a 60% return on investment. Where are you going to get that? That's a huge number. Don't let people just think about appreciation. Make sure they're thinking about appreciation, how it relates to their down payment. Inventory. So this is a really interesting topic, and I wish I should have made note of his name. On one of my daily postings, there was a discussion, because I wrote about home prices, et cetera, and there was a discussion about it. And this guy made a. Is that coming from my side?
No, it was Robert behind the scenes.
Oh, okay.
You're good, Robert. If you can hear us, you put it on mute.
That is so unlike him, man. Just usually so perfect. I guess he's human. Darn it. So what he said, because look, what's the risk to crashing housing prices? The risk is some level of seller panic, where they just roll their homes on the market and they do whatever they have to because they're in a panic mode, and buyers smell blood in the water and they don't attack. They back off and they say, I'm just going to wait and see how bad this gets. Number one, I'll show you another slide where that is not going to happen, in my opinion. But what this guy said was really sharp. Think about all of the people that have 3% mortgages, 3.5% mortgages. You would have to be like almost like mentally ill to sell a home that has a 3% mortgage and go buy a new one with a 5% or 6% mortgage. So yes, unfortunately, that will slow the move up market down, but it's also going to lock prices in place. People are not, and even my own daughter said it recently. She talks about, should I sell? Is this the top? Maybe we, do this, get some land. And then she said, but Dad, I don't want to lose that mortgage. So that's real. And I think it's a really important point for your buyers. Don't lose that one. But thanks to the guy that said that. I'm sorry, I don't remember his name. So median list prices, this is a bit telling here. And this, unfortunately, I only had data till the end of Feb. I think you're going to see some pretty decent softening here, but not like really, really bad. U.S. housing market has doubled in value since the Great Recession. Okay, so again, lock in on that one for a minute. Think about doubling your home price, in the last 15 years. It is insane. It will happen again. Don't think that it won't. And so that's why I say, do you really care if there's a dip? Do you really want to time the market on anything that's going to double? I don't. This is what's happened to mortgage payments. This is real. This. This is year over year. You can see a 31% increase in mortgage payment year over year. That's pretty big. But here's another slide why I don't think the housing market is going to get pummeled. This is what loans look like back in 03, 04, 05, 06, 07. But this is only part of the problem. These are all these mortgages. Oh, I can't mute it because I'm talking. Sorry, my dog. If you like a barking dog, I would suggest you get a corgi.
Stop it. He's called Mr. Potato Head. And his real name is Dan Jr.
His name is Dan Jr. So
It's all good.
All right, thanks, Dave. You always do that when my dog barks. So that's a big problem, guys. Look at the magnitude of this number in billions of dollars of sub 620. But you know what the average down payment back then was? Like zero. I don't think that was average, but I was in the non-prime industry and it was stunning how many people with 580 credit scores were putting nothing down. They had a poor credit history. They had no verifiable work history. They bought their homes at the very top and they had a poor credit history. You put all that together and then you take just even a 5% drop in housing prices with no skin in the game, with an already slightly, I don't want to say that, with a borrower that's had their challenges. We'll just say that. That's a recipe for disaster. This is not that. We have strong underwriting standards. We have a strong, reasonable DTI standards. It's a whole different time. Most people, I don't think, will walk from their home, and I don't think they're going to have a reason to walk from their home. So this is kind of just an early look at things are slowing. I know you know that in your market. Northeast has been hit the worst. So we're beginning to see a little bit of slowdown in sales. I think that again is a positive thing. I think that hopefully will help us build a little inventory, but it will also moderate prices. We want a healthy market, guys. I thought this was funny, but you can count me in on this stupid category, a panel of stupids, all these guys. This is where they predicted rates would be going. So the worst case prediction was Q2 and Q1 of 23, we were going to hit 4%. Whoops. So, really nobody saw this inflation thing coming. I'm talking about a year ago. This thing really did just rear its head almost out of nowhere. And you can count on this. And this sounds contradictory to what I said before. It is a slightly different argument. We're sliding down the credit scale. It happens every time the business gets tight. We keep sliding down the credit scale. There will be more and more low FICO programs. We will start building a problem for the next decade or the next 5 years. But what's the lending that as we slide down the credit scale now, it's not going to hurt anything for a while, but this will keep home buying active. Lenders always find a way to make loans. I thought these were just cool slides. These are more for you if you want them. This is the mixed impact of rising rates on housing. And what you can see is during times of some pretty big interest rate increases, like in 98 to 2000, rates went up almost 2%. Final rate was 8.5. Home prices went up 13%. And home sales barely moved. The worst period was right in the middle of that horrible housing crunch. Well, this was before the bad stuff got there, but this was when rates shot up. They hit 6 3/4. Home prices still went up, although sales began slowing down. So again, this is all to make sure that buyers don't freeze, because I don't think that they should freeze. And other than the crash of 2006, you can see that home sales were not impacted by rising rates. This is the story that tells. Rates went up, but housing sales went up as well. This is just another what's been happening since December. I think this one. You're living through that story. And this is seriously, you think that this? I know rates higher. I think this slide's slightly dated. Todd, what are rates today? Are they like mid fours?
No, I'd call it low fives.
Low fives now. Wow. However, this is what's been happening, and plenty of homes were sold. I swear to you, plenty of homes were sold. And then this is, again, just for you. You can have these. This is a buyer's purchasing power. I used 400,000 as the central loan, and then coming down from that. And this tells you that the difference from 3 to 4% was about $230 a month. And I know that's not nothing, but rents could easily blow that kind of increase away. And then this is the same number using a $500,000 loan up to 5%. And again, this was about a $290 increase going from 4 to 5 on a $500,000 home. That's like, less Starbucks. And this is an example of what can happen if, and I'm sure you guys have seen slides like this before. If I wait to buy a home because rates went up, and I get any kind of appreciation, and there's any kind of appreciation while I'm waiting, I end up making a higher payment, even though, wait, what am I trying to say? Oh, the decline in mortgage payment, because I'm ending up getting a more expensive loan. This is how much money you lose over the life of the loan. So it doesn't always make sense to wait. This is a concern. This is the affordability. This is what's happened. Just this September, guys, housing affordability went from 150 to 143. And I think that we will see this stabilize pretty soon, because I think that housing prices are going to stabilize. and maybe drop 5%, something like that. I do see some softening in home prices, and I think we may see almost enough softening to offset what I think is going to happen to rates, because I do think rates are going to get a bit worse here. So now let's talk about where I think rates are going. I think the last call, probably the last couple calls, I've shown this particular slide. This is just right off my own charting tool. This goes back into the 80s. So this was a slope down in rates. And as you can see, every time we touched the top of this trend line, we came down hard. Every time we touched the bottom, we came up. That's what markets do. They trend down or up, and you learn to trust these trend lines. The problem is that when these trend lines get broken, bad things happen. And we did break above this 40-year trend line. Although we broke above it briefly back in 2018. So there is still some hope. But at the moment, there's not a lot of resistance between the current 10-year bond of 2.70 and like 3%. So that's why I'm thinking it might get a little worse. This is what we call RSI, Todd knows this. And this is telling you that this is way overbought, meaning it really probably can't get much worse until it starts turning down. And you can see the last time it got overbought here, above the 70 line is overbought. Whoops, sorry. And it happened to touch the trend line at the same time it got overbought, and down we came. Here it almost got overbought as it neared the trend line, and it came down, et cetera, et cetera. So each time these two things come together, we have seen a pullback. This is a shorter term look at what we just talked about. This just goes back a couple months. And this was the trend I had been watching. So this is an example of what can happen when a trend is broken. We were in this trend for a matter of months, and then it broke above it, up we went. Now I'm hoping for, but this morning this did change a little bit. RSI can be, you should look at RSI almost like you look at price on any of these indicators. And what you want to see, we look for divergences. So here's an example of a divergence. RSI was dropping, but price was rising. These lines are exactly the same time period. RSI always leads price. So when I see these divergences, I'm ready to go short. And that's what these RSXs, each time there was a divergence. So this was a divergence and went down from 1.6 to 1.3, I think. Now we don't have a divergence, but we have maybe, if this can just keep curling down, maybe. This morning it kind of did stick its head above this line. Because alternatively, if I'm able to draw this line upward, like this one was a slight upward line from here, then we know it's not quite over. However, this is the sentiment. So this is really important. And this really suggests there is a turnaround coming. And it doesn't mean, all of a sudden things are going to get so great, but at least there should be a little relief. So this is sentiment. Sentiment can be tracked on anything. And when sentiment gets too low, it's a contrarian index. So when people are feeling so bad, I hate bonds. Bonds are the stupidest thing in the world. Why would anyone buy a bond? That's when the masses are down here hating something. Guess what? The mass is always wrong. It's time to jump in. And each time, without fail, when sentiment hits a certain level, it comes back. And most of the time, it comes back above the overbought line. Now people are too happy. And then we know, oh gosh, everybody loves bonds. We better get out. This is a perfect contrarian index. And look what happened here. And then the difference here in price was almost 10 points, almost a 10-point move. Now TLT is like a stock fund that only buys treasuries. So that moves just like bonds. And then the very last time that sentiment dropped, we got a pretty good move here. Sentiment is pretty ugly, guys. So I do expect a turnaround in sentiment and then a little bit of a relief rally. Add to that, well, I just wanted to update you. So I did this last time. This is called Elliott Wave, and Elliott Wave is a very complex way to look at movements in the market. And it's mathematic way to look at human emotion, essentially. And things move in waves. So even when price is in a downtrend, you have upward waves while it's going down. And waves move in 5 counts. So from here to here, this was a wave, and you can see 1, 2, 3, 4, 5 waves. And then we started what we call a new cycle, an impulse cycle. And that's been 1, 2, 3, 4. We got this bounce, and I showed you this, I think the time before last. And 5, we don't want to talk about it. But 5, and then you have waves on top of waves. So this 5 wave will not just keep going down. Next, we'll start a new wave count, probably anytime, and it'll be like 1, 2, 3, 4, 5. But ultimately, it will match this line down. But there's hope. This is seasonality. I wish I would have made this on 2 separate slides. But let me just tell you what you're looking at. This is a current period right here. This is measuring the time period from about April, the beginning of about now, to early May. And what this is telling you is bonds go up 50% of the time, and they go down 50% of the time. So there's zero seasonal advantage. So I wouldn't make an investment here. I always check seasonality because I want every edge I can when we take a trade. But look what's coming. That's the beginning of May. So the beginning of May, we start this seasonal edge that tells you over the last, I think that's 14 years, bonds have only gone down once. I mean, and I'm talking about bond prices, not yields. So 93% of the time over the last 14 years is an incredibly favorable period for bonds. And this runs up through, I think that's July. So there's hope coming. This will help. It always does. I'm not saying we're going to see that same amazing effect here, but I am saying we have a huge seasonal edge coming, and that should match about the point where that last wave I showed you bottoms. That's all I got.
Holy smokes. All right. So could get worse before it gets better. But I really think the thing that I keep focusing on that I wrote down that you said early on is that in markets like this is when you can grow market share. And I think that that's what all of you need to take to heart, is that you have this opportunity right now to be great, right? A lot of people are getting in their shell, right? We saw a 41% increase in loan originators last year. And a lot of those folks are going back, I think, to whatever their previous job was. And I just love, Dan, that you brought that up. I just kicked off my latest group of my operating system group. I guess I call it group training, group coaching program. And, that's it. It's a group that we're really trying to get people who are struggling to do 5 loans a month each year, consistently. And really, that's what I told them in the opening call. I said, hey, this is a great opportunity for you to gain market share. And so you kind of, if I can summarize that, you think we're going to have rates go up here for a little bit, but actually maybe in May, summer months, we could actually get a little bit of reprieve, or is that too much?
No, there will be a bounce. I see the bounce coming. I just don't want to promise like a big game-changing bounce. It's a bounce that will help people. Those bounces become more valuable than in a normal market. When rates have jumped up like they have 2%, people slowly start letting go of the 3.5. And now what they're looking at is, gosh darn it, 4.25 wasn't that bad, or 4.5 wasn't that bad. I just want to be in the 4s. I know I can't get 3 again, but I want to be in the 4s. So they let go of what it was, and now they just want what they could have had 2 weeks ago. They always want something from the past. So when you get these little bit of pullbacks, you put that in your CRM, guys, say he wants 4.5, and keep that in your notes. Make sure you search for that, because you will get a pullback, you will get reprieve, but I think it's going to be not a long-term one. I think the long-term big movement in rates will come probably about the third rate increase. And that's when you're going to see an unbelievable rally, because you're going to see a recession and the Fed is going to have a problem. And I think at that point, I'm hoping at that point, inflation is moderated just a bit. And that's probably, kind of a late third quarter-ish thing. But what you said, Todd, is so true. I'm watching people, fall like flies, and it makes me sad. But most of them are the people that came in. This happens every cycle. The business gets so amazingly good, and then all these people just come from nowhere. Nobody knows where they came from, and then they kind of take all the cream off the top, and then it gets tough and they go away just as fast. It's just right now we're in that waiting zone where we're waiting for all of them to go. And that's not hating on all the new people, guys. You hopefully are different. You hopefully came here for the long term and you can sustain this. But a lot of people cannot. So you just gotta, not everybody likes to hear this, but this will change your life. Todd and I just briefly talked about, housing and house sizes and all that stuff. And, he mentioned, hey, I'm still in a smallish house. And most of the really super successful people I know that have been in this business a long time do not just keep increasing their house payments during the good times. We've seen too many cycles, and it's never too late to downsize. It's oh my God, your life is just so happy when you're not waking up and thinking about paying your bills, and whatever you have to do to match your current income, you should, because as soon as you do that, somebody upstairs says, good job. I'm now going to reward you. And I'm going to give you lots of money where you didn't even have to do that. But it seems like when you don't do that, the pain just keeps coming. So don't think anyone cares about what you drive, and don't think about anyone cares where you live. Make your life simple.
All right, guys, we got about 15 minutes left. I want to put a close on this and wrap it around these three concepts. Loans now, like how does what you've learned right now potentially help you get a fence sitter off the fence and into escrow, help a listing agent get a fence sitting move up buyer off the fence and moving up. So what are some loan now content from this? Gain market share. Dan's mentioned it multiple times, and that's been the focus in the mortgage coach community. And how are you improving your competitive advantage? So I do believe that, not just watching this content, but putting this content into action. We will be putting these slides into our Facebook group. And I'm recommending each one of you, you're in local markets. You have a niche. Some of you specialize with military. Some of you specialize with physicians. Some of you specialize with first-time home buyers. That you're creating, this expertise in this toolkit of content and skills so that you can kill it, whatever your niche is. I had interviewed a loan officer in Connecticut last week, or maybe the week before, Tammy, and incredible conversation we had. And this is data from her market. So you can see in the bottom, it was from 1/1 to 3/18. And this was real localized data of what it took to get a home in escrow. And, she was talking about how she's using the appraisal gap strategy and the cost of waiting analysis, to help families navigate the current market. So, this is a little dated at this point. It'll be interesting to see what the next round of this slide looks like. But, I want to make sure you guys you dedicate some time after this call to go through Dan's slides. And he shared a lot, but there should be at least 3 of those that goes into your toolkit, and that you refine your conversation around those. You get confident with it. You bring it into the market, because this is a tough market. Like every loan officer in America sells loans, and your product is a lot shittier this month than it was last month. It's harder to sell higher rates. When everybody has, 2% lower, that's an easier product to sell. So the product got harder to sell. But guys, that's why it's important that you're not selling the product. You're selling how you solve problems. I'm going to show another slide. This is a quote I say a lot from stage, just about every time. These are my slides from a presentation I'm doing later today. And this slide will come up a few times.
I love that. I love that.
Well, it is what it is, guys. Like most loan officers are selling product, which means that's interest rates, it's their personality, it's how they dress, it's how they show up. But guys, in this market, you got to sell the problems you solve. That's how you get loans now, market share. And an example, a consumer that's like, oh, should I buy now? And if you're able to, through slides, through conversations, through a total cost analysis, you're going to win a loan and you're going to gain market share. So Dan, let's net out a few questions. So there's going to be a bounce. I'm hearing a lot of people say that, hey, they think there's going to be another refi market next year. So I've talked to a lot of ballers that are like, hey, I'm closing loans, putting people into it, but they're practically closing the second loan. Like, hey, at some point it's going to get better. They're making sure they're using their database. They're making sure that they have sales boomerang and alert engines. So they're getting alerts, and they're also platforming their clients, making sure they're in HomeBot. So if you close a loan, like, you should really be closing that loan, but pre-selling the next one and databasing it in a way that, when the market shifts, you're ready to go. What are your thoughts on that?
I think this is brilliant. I think, well, two things about that. Sell the problem you solve. So what is the problem? And you can define that problem for people. And in my personal opinion, right now, that problem should be getting priced out of a home, whether it's a rental or a purchase. That's a scary thought. We all have that Maslow's, hierarchy, and food and shelter is right there at the top. And to me, there's nothing better than locking in a mortgage payment and sleeping at night than worrying about what your landlord's going to do next month and next month and next month. Is a very dangerous problem right now, these rental increases, and they're not going anywhere. I don't see these rents coming down for a while. It makes a lot of sense. And so if the fear loan is, you can explain to people why you're doing that, and explain to them why, and show them some of these slides. Every time that we have a recession, rates go down a lot. And if you don't think there's a recession coming, here's a bunch of reasons why. That's what I've tried to give you, is the hope for the future. I wish I could give you hope for today, but for today, you've got to sell what you have. And what you have is pretty good, when you look at historical standings. And then one more thing I'll add to that is I should get educated better on current loan products, but these are the times where adjustables mortgages start emerging. I wrote about this last week, and I am such a huge fan of adjustables. A lot of buyers got turned off to them because they think of adjustables as what happened during the non-prime, the 2-year fix that was such a deeply discounted rate. Sure, those are dangerous, but a 5-year arm or a 5/1 arm or 7/1 arm, when people are probably not going to be in the home more than 7 years, those can be really powerful. I particularly love the FHA arm. The only thing is, full disclosure, I'm not sure where some of those rates are. We did have one of our market mentor members yesterday reach out, and there was a credit union that was offering 2.5% 7-year fixed. Kind of freaked her out. So I'm not surprised. That's what happens during times like this. And I said to her, well, yeah, why don't you call them and see if they want to take some brokered loans? Because that's what I used to do back in the day. Every time I saw something I hated, I didn't hate on them. I called them and said, hey, do you want some more volume? And, it was about a 50-50, but a lot of people, they want the volume. So don't be shy about that. And don't be shy about beating on your company. If they say, well, we don't allow brokered loans. Well, you better start allowing brokered loans, because sometimes you have to do that. So yeah, I keep your eye open for adjustables.
Yeah, and seller buy down. Scott Nicholson is going to be doing some training on seller buy downs. I don't know in this market, I'm sure there are some homes where you can do that, but in many cases, you're competing with, plus buyer.
That's a tough one.
Yeah, well, you could, if everybody's overpaying by 10%, you could overpay by 20% and do a seller buy down. So the seller buy down, there is a place, there is a time, but guys, this is the time in the market where it's up to you to tailor, teach, and control. You need to be paying attention to all the dynamics of the buyer, the agent, the seller, and then you need to be able to teach them ideas and concepts. Mortgage coach presentations, Dan Rawitch slides, keeping current matter slides. So let's go into wrap up mode. I want to make sure everybody noticed that Todd is adding some people to his Win by Noon operating system training. So I'm a huge fan of that. There's a link to get that. I think I've already said it. I'm a huge fan of market mentorship, and for any mortgage professional that wants to go deep with Dan Rawitch, be part of a community where you're literally, Dan does what he does in the mortgage coach community, but then he goes a lot deeper in the market mentorship. And it's a place where you can ask Dan questions. You have direct access to him. I know people in the market mentorship program that have put on realtor lunch and learns, and Dan has come in on Zoom and helped facilitate some of that. So if you literally want to be in Dan's community where you're getting more than just a morning update, again, not just because the morning update that he does is amazing, but if you want to go beyond that, Dan, real quick, tell everybody what they get and tell them where to go.
So the website is marketmentorship.com. And there are a few things. One, and it's become really popular, is our weekly video. It goes out every Sunday night. So every once in a while, I'll go out Monday morning, but I'm pretty dedicated to Sunday nights. And as Todd said, it contains these types of slides. And I try to keep the videos under 20 minutes. I'm really hurt that Todd listens to me double speed, but I'm going to get over that. I would have thought he'd do it on triple speed, but
it doesn't offer the triple speed, or I would. Actually, no, I couldn't see the graphs if you get it there, because the graphs are so good.
It's funny. I've gotten to the point where I listen to everything. I can't quite do double because I can't follow, but 1.5 is a minimum. I'll listen to stuff. We're also hyper. It's crazy. But I think the videos are good. And the reason I say that is I actually look forward to doing my weekly video, because that's when I educate myself. I learned so much about the previous week and what happened and what to expect. So I figure if I'm learning, you're probably learning too. And then I think that the stock picks are a pretty darn good bonus. We are up about 170% year to date. We have an 83% win rate. We've had one losing week in the last 32 weeks. And I just did a class. Todd, I should send you that, because I just did a class on how to use those stock picks to where you're not having to stare at your computer all day.
That would be great. I'm sure
so I'll get you that video.
Missed it. That would be awesome.
Yeah. Yeah, I think I did put it on Telegram, but it's hard to keep track with all these communication sources. And then I do 2 daily updates. I do one in the morning and I do one in the afternoon, with specifically talking about whether I think you ought to be locking or floating at that point and why. And I try to make the why clear enough that you can go talk about it with realtors. And then most every day I post content that you can personalize and make for your own, whether it's about rates, whether it's about home buying, whatever. And it's just stuff that you can take and make your own. And all that is $24 a month. So I came out with it, and Dave was like, "Oh, that's pretty cheap, bro." And I remember even talking to Carl White, and he's like, "Are you stupid? Like, how stupid are you to charge $24? Like, is that all you value yourself?" And I'm like, "Well, yeah." But no, the truth is, I really just wanted it to be a no-brainer. It's just, I just want you to be part of it. And that's a price point that everybody seems to be willing to jump into. So that's it. And thanks for letting me pitch that.
Yeah, no problem, guys. So check it out. Dan, you are such a gift to this community. I appreciate the daily updates that you put both in our Rate Watch app. For all you mortgage coaches out there, if you have not downloaded the Rate Watch app, get it today. Is it green today, guys? Actually, I'm logging in right now.
No.
Do you have it, Todd?
I do.
I have it. Yeah.
Pull it up. My internet not running very fast.
Here it comes.
I don't know. How do you?
It's red on my phone.
Bad at showing things.
It's red, guys.
Yeah,
Well,
it's red.
remember, those are great teachable images too. They're designed to be mobile first. You can pull them up mobile. You can share them mobile. And guys, this call is a wrap. I hope you got value from today's. Give it a like down below. If you got value, share it with your mortgage friends. Dan Rawitch, you're the man, bro. Appreciate you.
That was good.
Thank you. Yeah, we got that one pretty good. Thanks a lot, Dave, for having me. Thanks, everybody. I appreciate your support.
All right, take care, everybody.